welcome and thanks for joining us. Thanks for registering and giving your precious time. I'll introduce myself. I'm the host for SHM Indiana webinar today. My name is Suresh Lohano, and I've been a hospitalist for 17 years, pretty much. Med-Ped hospitalist at Davis Community Hospital, and I joined SHM in 2011 and have attended a few national meetings and has been involved with the Indiana chapter for the last few years. I'm the vice president till now, and then once we have next meeting with Converge annual meeting, I'll be the president for the Indiana chapter. Ramesh Adhikari is the president, and he's been the mentor for a lot of us at the chapter leadership level. He's actually with us also, joined the webinar. Ramesh, you're there? You want to say hi?
Hi, Suresh.
Yeah. So he's been phenomenal in hosting some webinars and meetings. So we'll just we'll thank him for founding the chapter and getting us together. Our guest speaker is Syed Nishat. He's our co-host. He's with the Wall Street Alliance Group, and he's a financial advisory firm specialized in financial planning for healthcare providers, including physicians and several other nurse practitioners and physician assistants. He is a partner at the Wall Street Alliance Group. He has been published at different, levels in Medscape, medical economics, MedPage. He has been advocate for physicians and healthcare providers for financial plannings, as well as the people or physicians or healthcare providers who make mistakes in their financial plannings. He also has been regularly quoted in an interview with Forbes, US News, 401k specialist, and Kevin MD. I'm sure you guys all know that. He will be talking about Biden's tax hike proposal and the effect on tax planning and estate planning for healthcare providers. So without any further delay, I'll give him the webinar so he can start his presentation.
Thank you, Dr. Suresh. You can hear me fine?
Yes.
Yeah, very good. So thank you, everyone, for joining. This event obviously is being recorded. And thank you, Dr. Suresh Lohano, to invite us. And I want to start by thanking you and all the healthcare providers for their hard work and sacrifice during this pandemic. And we at Wall Street Alliance Group provide wealth management solution for healthcare providers all across the United States. Now, taxes are a big issue for healthcare providers right now because the Biden administration obviously is very vocal about not only increasing the taxes, but also decreasing the estate tax exemption as well. And recently, the Biden administration just passed about a $2.3 trillion infrastructure bill. And whenever you pass such a large bill, obviously, it creates a budget deficit. So the number one question is that how are you going to pay for the bill whenever you have a big budget deficit like this? And most of the time, the simple answer is by raising the taxes. Now, there's a lot of variance in the infrastructure bill the Biden administration has proposed. But the most important thing you have to understand, and I would like to just put up my slide there for all of you to understand that how it affects you. So first thing to understand as an individual, those who are making more than $400,000 will be affected the most. So for example, if your earning is more than $400,000, if you look at my slide, the tax rate jump marginal from 37% to almost 39.6%. Now you might say, okay, it's about 3% jump. But one thing you also have to understand that as an individual, any income as a W-2, you don't pay salary more than $140,000, called a FICA tax. If your earning is more than $400,000 as a couple, I'm talking about, then any income more than $400,000, you do have to worry about paying additional 12.4% Social Security tax. It's a big tax you have to worry about. And lastly, that as a small business, for example, if you do locum, it's quite common for physician or healthcare providers to work as part-time, get 1099 income, you can do something called itemized deduction. If a combined income goes over $400,000, right now you can still itemize it. That start to phase out as well. Just in case, if your income is more than $1 million, we are talking about a long-term capital gain and dividends going up from 20%, which is currently right now, to about 39.6%. Long-term means any stocks, any real estate that you own, that you sell it after a year, you only pay 20% tax. Now with the new proposal, you will have to pay 39.6%. And last week, Biden administration came in Bloomberg, he said it's not going to be 39, it's going to be almost close to 43%. So it's almost double we're talking about. And lastly, the 401k contribution, this is not part of the infrastructure bill, but this is there in the tax proposal. So in a 401k, all the healthcare provider, you contribute, you get something called an upfront deduction, depending on your tax rate. For example, hypothetically, if you make $400,000, typically you earn a 33% tax bracket. You can contribute about $26,000 into a 401k plan if you're over the age of 50. If you're in a 33% tax bracket, if you take a look at my slide, 33% of 26,000, you save around close to $8,500 in taxes. That thing, according to the new tax law proposal, will be gone, will be going away. The deduction will be replaced by something called tax rebate. So it's called a tax credit. So the way it works, regardless of your income, the tax credit will be 20% of the amount you contribute. So the same person who's contributing $26,000 get a 33% deduction, now will be getting about 26% deduction tax credit into the 401k contribution you do. So the amount goes down from $8,500 to only $6,700. So high earners will be affected the most. The issue will be is because the tax credit goes away. But if your income is lower, the good thing will be you'll be actually getting higher tax credit. So for high earner healthcare providers, we do see that the Roth 401k is more profitable to do it because the tax deduction going away. But again, these are few of the criteria that are available, but the most important thing for the healthcare provider, just make sure your income as a couple joint stays below $400,000 so you don't get hit too much with the Biden new tax law.
So what do you think, Syed, we have the solution for healthcare providers for this Biden's tax proposal coming up?
Yeah, so still we believe that the best way to contribute money or saving money in taxes for healthcare provider is when you contribute into retirement plan. Like every $10,000 you contribute into a retirement plan, if you're in a 35% tax bracket, we're looking at a tax savings of almost $3,500 immediately. There are different types of retirement plan out there, but just to give you an idea how a cash balance plan works. If you are self-employed physician or healthcare provider, and you work any income beside the W-2 from the hospital, in a cash balance plan, if you're over the age of 60, you can contribute almost $260,000, and this money is completely tax deductible. So if you're in a 35% tax bracket, we're looking at a tax savings of almost $91,000 per year. And in 10 years, it translates into almost $900,000. Now, obviously, everyone's situation is unique, but remember one thing I mentioned about the Biden's tax deduction going away. That doesn't affect the cash balance plan. Mainly, they spoke about the 401k. But still, if you, let's say, have a 1099 income as a locum, you can contribute almost $260,000 and try to reduce your overall income to below 400. Now, you may say, hey, I don't want to contribute too much. Do you have something smaller contribution we can do? So hospitalist or healthcare provider who are getting 1099 income, they can think about contributing into a SEP IRA. In a SEP IRA, you can contribute 25% of your W-2 wage. Money is tax deductible. You can also contribute into an IRA account. In an IRA account, you can contribute almost $7,000 if you're over of 50, and this money, again, tax deductible. And one last thing I just want to mention that is very common for healthcare provider to actually have a high deductible health insurance, very common from the hospital. And we highly recommend to open something called an HSA account. It's a health savings account. For the family member, you can contribute almost $7,100, and this money, again, is a pre-tax money. And the beauty is, Dr. Lohano, that this money after the age of 66, you can use it for health reason as well. It can work as a supplement for the retirement account as well. So for hospitalist or for healthcare provider who is having any income beside the hospital can consider these retirement vehicle to lower their overall income.
So, can you clarify the cash balance more about the age 60 and the SEP IRA of the age 50? Is that, can younger people do that or?
Yes. So younger people, this is the maximum limit I'm talking about per year, $260,000, just as an example. For younger people, the amount will go down. It's an actuarial calculation that we do it for the client. So just to give an idea, someone who is over the age of 50, they can easily contribute more than $150,000. So as the age goes down, the contribution amount goes down. As the age goes up, the contribution amount IRS allow you to contribute more. So the difference between cash balance plan and SEP IRA is that there's a minimum contribution due every year. We sit down with the actuary, and based on that, we can tell you how much contribution you can make in cash balance. But anyone can do it if you have a 1099 income.
Okay. So what about these backdoor Roth IRA and post-tax IRA and all those? These you can do those as well as the other, retirement accounts.
Yeah. So this point I'm trying to make for healthcare provider who don't have any 1099 income. For example, what do you do in this situation? So in your situation, obviously you should max out your 401k and 457 plan as much as you can. In a 401k 457 plan, over the age of 50, you can contribute almost $26,000. Again, these are all pre-tax money. Also, a lot of physicians in Indiana and Kentucky are not aware of it. There's something called a 409A plan. Not all hospitals allow it, but if your income is more than $40,000, and eventually if you become a highly earned salaried employee in a hospital, they do offer it. Just talk to the HR about it. The difference between 401A and 409A plan is that you can defer almost 70% to 90% of your income, all money tax deductible. The issue with the 409A plan and 457 plan is the principal are exposed just in case if the hospital filed for bankruptcy. It is not 100% protected from creditor. So we're not suggesting to put a lot of money into it, but depending on your individual situation, speak to your CPA if a 409A and 457 plan makes sense or not. And lastly, that another strategy we see healthcare providers don't use, regardless if you have a 401k account or not, you can always contribute in something called a post-tax IRA account. Post-tax IRA means you don't get the deduction. You contribute money into it and flip this money immediately, convert this money immediately to a Roth IRA. It is called a backdoor Roth IRA account. In a backdoor Roth IRA account, husband, wife together over the age of 50 can contribute $7,000 each. And the beauty is this money grows tax-free. Withdraw is also tax-free after the age of 60. Now, I was talking to a client of mine in New Jersey who was also a healthcare provider. We did the math. The client was 50. He's a physician. The wife is also a physician. They can all contribute $7,000 each. And we did the math in 20 years. If a 7% growth happens, the value becomes almost $600,000. And again, all the money are tax-free. So I think it's one of the underutilized strategy in the healthcare provider sector. Definitely speak to your financial advisor about a backdoor Roth IRA account.
Okay, so that's good. How about anything other than any other tax deduction beside the retirement accounts? Is there something else healthcare providers can do, including?
Absolutely. So one more thing is very common that for healthcare provider to invest into real estate. They have their sometimes own practices. They pay themselves a rent. Is extremely common. Now, if you invest into real estate, keep in mind to look something for opportunity zone. Since 2017, it's become very popular. Opportunity zone means that you actually invest into an area where there's a 20% poverty rate. The benefit to it, if you buy property into those kind of distressed area, buy the property and leave it there for at least 10 years, any profit happened by selling the property, capital gain, there's no taxes in it. It's extremely powerful. So this law is still available. So opportunity zone, talk to the realtor that to buy opportunity zone for a real estate investment, number one. Number two, when you buy a real estate, another strategy is that healthcare provider don't utilize too much. It's called cost segregation. Any real estate you buy it, if you look at the second point in the slide, there's a depreciation schedule. It's about 39 years. What depreciation does, any income you collect from the property, you get to write off because the value goes down every year. Cost segregation, all it does, that it does advanced depreciation from 39 years, it bring it down to 5 to 7 years. So you get the bigger deduction, you can use this money and get to write off or rental active and passive income. I just want to give you a real example. A client of mine who was also a healthcare worker in Texas, he recently did a cost segregation. He purchased a property. We did a cost segregation, $1 million property. We got immediately a $250,000 advanced depreciation, and any income the property will get, rental income, the client doesn't have to worry about paying any taxes of $250,000. Again, cost segregation costs some money, but if you have a lot of real estate, if you have your own practice, consider doing a cost segregation for real estate. And last 2 points, very briefly, I want to mention, because if I want to cover the charitable contribution is a webinar of its own. So very briefly, I want to talk about advanced planning is also available. Like nowadays, it's very common for healthcare providers to take a look at TV and doing a lot of buy and sell stocks, very common into apps. One thing you have to keep in mind, if you buy, sell, too much into stock and make too much money, those are part of your income though. So the 400,000 we spoke about, that not only just earn income, these income as well. So try to do active management into the retirement account. Non-active management, try to get into like municipal bonds or, for example, index funds, leave it there for long term. So you don't have to worry about paying taxes on it unless you sell it. So I think that's very important, that do a tax efficient investment rather than buying and selling stocks. And lastly, I want to talk about that for healthcare providers who are over 70, in retirement account, there's something called required minimum distribution you do have to take. Required minimum distribution means that a certain amount of money every year you have to withdraw it after the age of 72. If you're charity minded, one thing you can do, rather taking money out from the retirement account, you can give money directly from the retirement account to a charity, and this money will not be part of your income. So in this way, that your income will be below 400, number one. Number two, there's something called charity. You can contribute and get money as an income as well. If you're interested into advanced planning, we can sit down and discuss with you. It's called Charitable Remainder Trust as well. But again, these are out of the scope of this presentation. But if your income is very high, net worth is very high, you can always call us or speak to your financial advisor about Charitable Remainder Trust as well. That will give you advanced tax planning.
Okay, well, that's good. So let's, can you explain the estate planning more on the high end? What is it for physician? What are the important points for the estate planning, and what is going to happen with Biden's tax plan in terms of estate planning?
Yeah. So one thing we have to, I just want to clarify that estate planning is extremely important for healthcare worker, especially if you are, because they're on the front line in battling this pandemic. One of my best clients recently passed away battling COVID-19. And I was reading an article in Medscape that over 4,000 healthcare workers died battling COVID-19, and over 450,000 get affected due to COVID-19. And the client I'm talking about, I cannot imagine, that recently passed away. He doesn't have a will and he doesn't have a trust. Because just to give you an idea, if my client did not have a simple will, something as simple as the custody of his children would have been decided by the US government. And his estate will be going through a lot of probate process. Meanwhile, the beneficiary didn't need money. He would not have access to it. So that's why, like my clients, healthcare provider must get their basic will and trust done as soon as possible.
So what is the, and of course, we have some questions. We'll get to those. If we can proceed further with the estate planning, and what are the changes coming in the new tax law and how it affects, especially the healthcare community?
Right. So one thing I just want to explain, what are the changes coming into this estate planning and how does it affect you? So if you look at my slide, there in US, there's something called income tax. Unfortunately, there's something called death tax. That is called estate tax. So the good thing is that you don't have to worry about paying any estate tax unless your net worth is more than 23 million. It's about 10 million each, 11 million each I'm talking about. But the bad thing is Biden administration is extremely vocal about lowering the exemption. And recently there's a bill proposal came in. The amount proposal there is 3.5 million per person. So anything more than 7 million after you die, the beneficiary has to worry about paying something called estate taxes, all right, which is quite significant, and it's not uncommon for healthcare providers to actually have this much of a net worth, especially if you're close to retirement. So there's a few things you can do. Right now, you can actually gift your children almost close to 22 million because the law allow you out of your state if you want to. And this money will be out of your state and the money will grow state tax free. This is one option you can do it. Number two, every year you can give gift to your children $15,000 per child. If you have two child, 30,000, husband, wife together can give $30,000 every year to a child. And you don't have to worry about filing any gift tax. And this money is out of your state. You can buy, if your net worth is that substantial, let's say more than 7 million, 8 million, you can think about buying a second to die life insurance policy. That's very cheap, but it gives you a lot of debt benefit, and that you can use it to pay for the state tax that might be due. And then if you own life insurance under your name, one thing you have to keep in mind that once you die, it is income tax free, but this money is part of your state though, the life insurance death benefit. So one option could be that you can create a life insurance trust, move the money from individual name under the life insurance trust, and this money is completely out of your state. And lastly, as I explained about charitable remainder trust, if you want to give money to your children as an income, you can just give the money to the charitable remainder trust, and that charitable remainder trust can pay income to the beneficiary for a certain period of time. So these are some of the solution and the problem, but the problem doesn't arise unless your net worth is substantial. But just keep in mind, it's about to go down. The proposal is. So speak to your financial advisor if your net worth is substantial enough to do some of the strategy we discussed about.
So when you say net worth, that include the life insurance once you get at the death, is that true?
Correct. Everything is part of it, is all together. Right now, obviously, it's very high, 22 million, but the proposal is 3.5 million per person. That's the proposal is. So it's all depending on what your situation is. You can definitely speak to your financial advisor about this.
So can you tell us more about the trust? What the trust is, why it is important to have it, and what are the common estate planning mistakes we make?
Yeah, so first thing, a lot of people ask this question that, hey, Syed, I have a will. Isn't it enough? If I die, my family will get all the money. It's a common misconception people do have it, because if you just simply have a will, it's not like tomorrow your beneficiary get the money. Usually what happens that as a trustee, you have to take the will. If anything happens to you, who's going to be your trustee? You have to send the will document to the court, and the court takes the will, authenticate it, and then release the money. It takes some time, authentication. So it takes depending on the state you live in, few weeks to few months. But this time is called probate. And in certain states, the probates are very long. So meanwhile, the beneficiaries need access to the fund. They cannot, because the money gets stuck in a probate process. So will itself is okay, but it does not avoid probate. So the best way to avoid probate is creating a revocable trust. And the revocable trust, what it does is a private document you create with an experienced estate planning attorney, and you move everything under the name of the trust, like your house, your life insurance. You update the beneficiary of the trust as well. So if just in case anything happens to you, all the money moves to the trust immediately the next day, and your beneficiaries don't have to worry about any probate whatsoever. Life will move on as it is. Obviously, there's no way to replace your death, but at least having a proper estate planning give you the peace of mind to your family, and let them actually focus on the most important part, which is actually the family. So that's why make sure that get the estate planning done and do it properly. Don't just have a will, have a revocable trust as well.
So does a trust, moving the trust, does you give you some protection from litigation, any of those things? Is that part of it, or?
Yeah, so during your life, obviously, whatever you move into the trust is a revocable, so it doesn't give you the asset protection. But once your children inherit the money, that trust by law becomes irrevocable. So if tomorrow your child inherit the money and grow older and then get married and get into a divorce or lawsuit, as long as the money stays in the trust, is all 100% asset protected for the beneficiary. but not for yourself though. We have to do some different kind of planning for it, which is called advanced, asset protection planning, like LLC or irrevocable trust. But it does protect the beneficiary from potential lawsuits or divorce. So that's why it's extremely important to get a revocable trust as well.
Okay. So going back to the Biden, tax plan and lowering the exception limit for the, the estate planning, can you explain, can we do anything about to lower it, or can we do anything to avoid that? Is that, what are the, vehicles for that?
Yeah. So one thing is that one law that actually changed last year. This is not related to completely the Biden administration because they just made a proposal, but one law already become effective last year, which is the year 2020, is called Secure Act. Is setting up for the whole retirement, community act that got passed last year. So before Secure Act, what it used to happen, if anything happens to you, your beneficiary get the retirement account. That beneficiary has the whole life to take money out slowly, depending on the age. So for example, someone 25, your child, and inherit the IRA account, that child actually have whole 50, 60 years to slowly take the money out. So the money grows as well, and you can take the money out and pay taxes slowly. Secure Act was passed last year. According to the Secure Act, beneficiary who are non-minor after spouse inherit the money. Now they have to exhaust the money within 10 years. So just to give an example, let's say a physician have a $5 million into an IRA account and leave it for the children. If you took a look at my slide, that child now either have to take $500,000 every year and in 10 years have to exhaust it, or $5 million at the end of 10 years. So we're talking about a substantial amount of income tax. That's the big problem with this whole situation. So the beneficiary have to worry about paying 2.5 million income tax. So this law already got passed last year, and it is not uncommon for healthcare providers to put most of their nested egg into the retirement account. So some sort of planning should be done to avoid this income tax that might be due. And just to elaborate your question, you mentioned what could be done. Like I mentioned about the Roth conversion, one option could be that you can convert the IRA account to a Roth IRA, and the benefit will be when you take a distribution, there's no taxes due. Second option could be that you can make the grandchildren as a beneficiary. Third option could be you can buy some life insurance to pay for the income tax that might be due. Or another option could be that you can use more money from the retirement account for yourself. In this way that you exhaust the retirement account, leave the non-retirement account to the beneficiary. This could be one option. Or the other option could be combine all of this, depending on which one is applicable situation for you. But it is important that you speak to your financial advisor to talk about the Secure Act that actually passed last year.
Okay, that's good. I think, Syed, we have some questions on the chat, so we'll see. So first question is, can you clarify backdoor Roth IRA more?
Yeah, so let's say, for example, you have a 401k plan. If your income is, let's say, more than 100, I think the law is about close to over $178,000, you don't qualify to contribute into a Roth IRA, all right, because your income is very high as an individual, all right? So what's the situation? I want to put money into a Roth IRA. The situation is you create a post-tax IRA account, a traditional IRA account. You contribute money into it. What's the amount you can contribute is $7,000. If you're over the age of 50, that's the maximum limit. If you're below 50, the amount is around $6,000. Now you contribute post-tax money to the IRA account, but you immediately convert it. In conversion, there is no income limitation. When you convert it, the money immediately converted into a Roth IRA. Since you're immediately converting it, there's no taxes due on the principal, and since it's conversion happening in a very short period of time, there will be very minimum taxes due on the profit. But the benefit will be it is converted to a Roth IRA. So the reason is saying backdoor because you're taking a backdoor approach to convert the money to the IRA to Roth IRA. That's where the terminology comes in. But the benefit is the money grows tax-free. Withdrawal is also tax-free after the age of 60. And after 5 years, you can even take the money out. For example, if you're buying a first-time house, up to $10,000, you can take out tax-free. You can use the money for educational plan and stuff like that. You don't have to worry about paying any penalty. A lot of advantage. So Roth IRA is extremely powerful. You should fully utilize as much as you can.
That explains. So the next question is, if we sell stocks or ETF in the retirement account with profit, do we pay tax in the current year?
No, retirement account, remember that anytime buy sell you do it, you don't pay any taxes. It's a tax deferred vehicle. Unless you take the money out from retirement account, there's no taxes.
Okay, and then next question is, how can you give money to children through charitable remainder trust?
Yeah, so charitable remainder trust, this is basically advanced estate planning. So you can give it during your life, or you can give it after your death. So in a charitable remainder trust, just give you a synopsis, because as I mentioned, this is advanced planning. So everyone give money to the charity. Let's say, for example, I have charity A, I have decided to contribute 200,000 every year. In 5 years, I contribute almost $1 million into it in a charitable trust. Now the charitable trust, eventually the purpose is to give the money to the charity you choose, you designate. But but if you are thinking that give the money in installment, but hey, is there any way I can get some income as well? Charitable remainder trust is a type of trust that allows you to take income as well. The whole philosophy behind it, that once you contribute into this trust, you invest this money into some mutual funds. The money grows, you take up some money. So the whole idea is that the growth will be enough for you to take out income for yourself. But you are able to significantly contribute this money to the charitable remainder trust. That's the whole idea of charitable remainder trust, that you want to control it, let it grow, take some money out as income because the market is giving you the return. Now, the question was, how do you give it to the children? So if your net worth less than $10 million, what you could do after you die, from 10 million, let's say $1 million, give it to the charitable remainder trust and make the income beneficiary to the children. And the children can take as an income, like the way I explained to you, for 20 years, for 30 years, the attorney can do the math for you, the schedule it for you. Whatever income is collected, the children can actually collect it and pay their bills if it's needed.
Could you talk about more of college planning, and especially in Indiana? I think there is some vehicle for having more tax break. Is that true? Or
well, right, in 5 to 9 you can contribute. In Indiana, the unique thing is you get a flat 20% of the amount you contribute. Maximum is $1,000 as a estate tax deduction. So I think it's very, very good. So if you contribute, let's say $5,000, 20% of that, about $1,000, you get a state tax deduction, state tax credit. It's not significant, but definitely it's a dollar amount you're getting from the state tax credit. So why not? So I think it's a good idea to contribute at least $5,000, depending on your situation, into the 5 to 9 for Indiana.
Okay, that's good. There's one more question. What advice you would have about converting money from IRA to Roth? How much is ideal? Is there a certain number?
Yeah, so I guess the question is that converting money from IRA to Roth IRA. So the best way to do it, and again, everyone's situation is different. You should do it when the market is down. So let's say, I'm giving an example, you bought Tesla, a stock right now $800. For some reason, something went wrong, the car caught on fire and stock went to $800 to $600. So at that time, you know what, stock is down, the $600, you convert this money into a Roth IRA from IRA account. You transfer the position from IRA to Roth IRA. So now you transfer it from $600 shares to the Roth IRA. The stock goes back up from $600 to $800. It grew tax-free. So the losing position, you should move it to the Roth IRA. That's the ideal situation when the market is down. Or the second option could be pick individual stock that are down right now, you think will go back up, transfer it as well. That also will help. But the whole idea is that your income should be down. So usually people who are close to retirement, they should do a backdoor Roth IRA for sure. And those, when the market is down, that's also a good situation to do a Roth conversion as well. Both options are good.
Okay, I don't have any more questions from the audience. I'll just do you, so can you tell us more about how do we reach you, contact you, anything else, other advices for physicians and other healthcare providers on the webinar right now?
Sure. I'll just share my contact information here. Anytime you can Google us, you can see us. We all appear in media, or in Medscape. You should be able to find out as well the different articles we write about healthcare provider. And my website is there. The phone number is there as well. But I just want to conclude by saying that, like it or not, that estate planning, asset protection, college planning, budgeting, tax planning, retirement planning, these are the foundation to give your family stability. And healthcare provider has unique needs, and a fiduciary financial advisor should be able to sit down with you, look at your big picture, and could create a financial plan customized for you in a 360-degree angle that can take care of all this aspect under one umbrella very efficiently. So you can give us a call anytime, or local financial advisor. Make sure they're fiduciary. Feel free to use them, because healthcare providers need financial planning more than anyone else.
Thanks, Syed. I think there is maybe one more question. Can you shed light on UGMA/gift account? Is growth and withdrawal in these accounts taxable?
So UGMA account is basically UGMA account. So the way the process works, that I mentioned about like giving $15,000 per child as a gift. And what you could do, you can open a UGMA account and contribute money into it, that money. The beauty of UGMA account, that the tax rate usually is a little bit lower, because it's usually taxed under the beneficiary's Social Security, whatever the income you collect. And you have some flexibility, but so completely control it unless the child over the age of 18, depending on the state, some states are 21. Obviously, you have to convert the money from the minor account to the individual account of the child. But you can just take the money out, distribution, any reason, doesn't have to be for education purpose. You can use the reason for money for any time. But when you take this money out, you do have to worry about paying taxes on the minor Social Security.
Okay, well, thanks. I don't have any more questions, so I guess we will conclude our webinar. Thanks for your time. Thanks for coming in and talk to us. As an SHM Indiana, we plan on having some webinars like this, which are not really CME or medicine, medicine related. I think we'll bring the series of seminars, including, like we talked about, financial planning, and maybe next one could be about contract negotiations with the hospitals, and also malpractice, how to save yourself. So watch out for those. Again, I appreciate everybody attending this evening, and if there's any question, please feel free to email me or Syed, and we'll see you next webinar.
Okay, thank you. Really appreciate everyone to coming in. I really appreciate your time.
Thank you.
Thank you.